To meet you all this way. So I'm not sure what's the skill set level of all of you. I put together a few slides. I'll go through the slides. As we go through the slides, I'll explain some of the concepts. So before we jump into the slides, so let me give you guys my background. So I have been in the IT industry for more than 20 years now, worked in various verticals. I also worked in the financial industry as well. So in the financial industry, I worked at interactive brokers. Some of you might be using interactive brokers as your trading platform. So that's where I was there for 3 years in the middle office. So I learned quite a bit about the stock market and other financial markets over there. So I've been trading stock for the last close to 20 years now, but options, futures, Forex, a little bit, or I would say last 10 years now. So for this session, I need 2 volunteers who has knowledge of the stock market, but very little knowledge about options. Maybe if you guys can raise your hand in the chat room, we'll use those volunteers kind of ask some questions as I go through the slides. So we'll definitely open up for others as well for the questions. Just to kind of make it a little bit interactive. Again, I just want to let you guys know that this is the first time I'm doing this options knowledge sharing with others. Some of the topics I have might be very basics and some of them might be over the board because some of the things I might assume. So if you guys don't understand or if you want me to go over any of the topic, just let me know. Right, based on how you guys rate this presentation, maybe we'll adjust next time so that that will be more tailored towards based on the audience. Okay, so do we have volunteers?
Yeah, Srini, we have a few people. I think Gagan is one. I can be another one if that works. But definitely few more raise their hand.
Okay, awesome. All right, you guys are going to have an exam now.
Okay, let me, Gagan.
Okay, so I'm going to share my screen, just a second. So, all right, so before we get into options basics, let's quickly go over stocks basic, right? Because stock options are all based on the fundamentals of the stocks, right? So I'm assuming everybody knows what a long position is. So pretty much you are buying a stock with an assumption that it's going to go up, right? You're paying a full money for the price of the stock, and as an investor, you make money when the stock price goes up. So second thing is a short position, right? So in this case, investor actually owes a stock to somebody else, meaning the investor doesn't actually own the stock, but he goes ahead and sells that stock to a buyer. Right, with an assumption that, okay, the price will go down so that he can buy the stock at a lower price and give it to the person from whom he borrowed it, right? So all that borrowing, all that happens within the platform you are using, so you don't need to worry about it. But just understand that you're selling something you don't own with an intention of buying that at a lower price later and giving back that stock back to the person who let you borrow the stock. Okay, so when you're shorting a stock, that means you're expecting the price of the stock to go down. Okay. So who do we have for volunteers? So can maybe one of the volunteers, can you tell what is the maximum loss with a long position? So for example, if you buy a
whatever
stock,
the premium we paid.
What is it?
Whatever the premium we paid.
Right. So whatever the cost, right? So for example, if you bought Apple stock for $150, maximum loss you can get have is $140, meaning the company goes bankrupt, right? So companies like the Apple may not happen, but it's like worst case scenario. The company goes bankrupt. That's a maximum loss, correct? So pretty much the cost of this share, right? So what is the maximum profit with the long positions? If you buy a stock, what is the maximum profit?
I mean, it depends on how long you want to hold all that, but unlimited. We don't know how long, wherever.
That's exactly right. It's unlimited, right? So depending on how far that company runs, meaning keeps making profits, and investor takes the stock price up, so it can go forever, right? So it's from the perspective of our discussion, it's unlimited, right? So there is always upper bound somewhere, but let's assume it's unlimited. That's good, right? So now let's look at the short position, right? What is the maximum loss with the short position? Say if you're shorting a stock, for example, Apple at $150, right? And what is the maximum loss as an investor?
I never did short, but I think it's unlimited too.
That's correct. It's the other side, right? Because you're expecting the stock price to go down, but it can keep going up forever, right? If the company is doing good, so you have unlimited. So now the maximum profit with a short position.
Maybe premium.
Yeah, so yeah, it's whatever is the price at which you shorted. So if you shorted the Apple stock at say $150, so maximum profit you can make is $150. Is that clear to everybody? So understanding the maximum loss based on the movements, the price movements, the maximum, it kind of forms the basis for options and other derivatives. I'm assuming everybody is clear on this. Okay, so let's go to the next one. So I don't know if you guys heard about the term derivatives. So if you're in the financial industry, a lot of people talk about derivatives, meaning it's a derivative of the underlying asset, right? It's a kind of a financial contract whose value depends on the underlying asset. So in this case, asset can be a stock, it could be a commodity, it could be a bond, it could be a currency or interest rates. So you're not directly trading the actual asset itself, but we're going to write a contract, or and then you're going to trade the contract. So think of it as more or like when you want to buy a house, you first write a contract, right, to buy that house for a certain price. So it's pretty much a similar concept. It's in case of house, the underlying is the house. So in case of stock market, the underlying is a stock. So most common derivatives include options, future contracts, forwards, and swaps. Right? But for our session, we are going to just concentrate on stock options. So stock options are usually the options on the derivatives for stocks and ETFs. So if somebody says a derivative, it's pretty much they're talking about a financial contract, which could be an option. All right, so let's move. I'm going to quickly go over, okay, there are what types of options are there. So don't worry about that. We're going to get into details of each type, right? So when you hear the term options, you basically hear two types. One is call options, another is put options, right? So these contracts, these options, when somebody is trading, it's always from the buyer's perspective. So when you hear the term call is actually a right to buy at the contract price. So you're pretty much writing a contract saying that I'm going to buy this asset at this price. Opposite to call is a put. So put is pretty much a contract that gives the right to sell at contract price. You're pretty much writing a contract saying that I can sell this asset for you at this price. So contract price is the price at which you are going to execute that asset. Meaning, for example, if you write a contract to say that I'm going to buy a house for $100,000, right? The contract price is $100,000. So it's in options industry that is referred to as strike price, which is nothing but a contract price. And then we have two types of, at least in the tradable options, there are weeklies and monthlies, meaning there are options that expire every week that you can trade, or monthlies that expire every third Friday of the month. So don't worry about all this, just remember that we have two types of options. One is call option, other one is put option. Call option gives you right to buy at the strike price. A put option gives you right to sell at the strike price. Okay. Okay, so options risky. So it's something that you keep hearing, are options risky, right? So you see a lot of people, or you hear a lot of people saying, oh, options are very risky, don't do it, right? It's a general, I would say, misconception that option trading is risky. Yes, options can be risky, but they don't have to be. Meaning, it's because remember, at the end of the day, we are actually trading a contract that's tied to an asset, right? So if you're trading stocks, yeah, stocks have the same risk as options, but of course, the options give you a lot more leverage than stocks, so you need to be a little bit more careful. So yeah, so pretty much we're saying the same here, saying options can be less risky or more risky, depending on your risk tolerance, right? If your risk tolerance is high, you might be taking the same risk even in the stock market, borrowing your money to buy the stock, or you're shorting a stock and it might be moving in the reverse direction, right? It's similar to stocks. So options have other advantages compared to stocks. It can be used as a tool for speculation with very less investment. And you can use it for hedging or protection or leverage. Like it gives a lot of leverage, like with very little money, you can get a lot of leverage. Just to summarize, yeah, there's more than one way to make money with options. It actually provides a lot of ways to make money, but you need to be careful in the sense use more options mean you need to understand before you get into more advanced strategies that you want to implement. Options, like if there are a lot of contracts are trading, or there is a lot of open interest in the options, it's actually a good indicator even for the underlying stock as well. So that's something, maybe I'll go through some of the examples, then you can understand how you can even look at the options and kind of speculate, oh, what are a lot of people speculating for this particular stock? So that helps you make a decision whether you want to buy at this price or maybe at a lower price. So you can even sometimes speculate, okay, the price is going to go up or go down based on the open interest. Okay, so let's go through call option. So at the end of this slide, maybe we'll open up for more questions because it's very important everybody understands what the basic call option is. So I'm going to just go through a very simple example and try to apply options on top of the shares. So just to explain the concept. Okay. So we have a simple scenario where Sam bought 100 shares of Apple at $100 per share, right? He bought the share maybe 7 months before. He got it for $100. Currently, Apple is trading at the $140, right? And Sam is kind of debating, whether should I go ahead and sell the stock or should I keep it? And he's seeing that the stock market is very flat. It's kind of fluctuating between 140 and 150. Maybe he's thinking about selling at 145, right? But he cannot sell it at 144 because current market price is 140. So then there's a Bob, the buyer. He offers to buy Apple stock in 1 month from now for 144 per share, right? And he says, okay, I can actually pay you an additional upfront fee of $2 for each share. It's almost, he's saying, okay, hold on to that stock next 30 days. And I'll buy it from you for $144, right? And I'm going to give you additional upfront fee of $2 per share. So now Sam and Bob enter into a contract saying, okay, that, Sam will sell the 100 shares of Apple in next month, anytime to Bob for 144 per share. And as we discussed earlier, mentioned earlier, 144 is referred to as a strike price or exercise price. Sometimes you hear the term exercise price as well. And Bob has agreed to pay additional upfront non-refundable premium of $2 per share, right? So that is, so one other thing is with the options, we are always trading in chunks of 100 shares. So that's a key point everybody should know. So in this case, so Bob is writing a contract with Sam saying that I can buy 100 shares and there is a $2 premium for share. That means Bob is going to pay $200 for 100 shares right now, so that Sam can hold that shares for next 1 month for him, right? So in this case, Sam is the seller of the contract and Bob is the buyer of the contract. And underlying asset for the contract is Apple stock, right? So underlying for this option is Apple stock. So this type of contract is call option, right? So earlier we said call option gives right to buy, right? So you're always looking at it from the perspective of the buyer of the contract, meaning who is spending the money, right? In this case, Bob is the buyer of the contract. And Bob is the one who is getting the right to buy the stock at $144 per share. So another point, so in this particular case, Sam already owns the stock and doesn't need to buy the stock in the market to deliver, meaning after 1 month, Bob says, so I'll go ahead and buy the stock from you for $144, right? Sam already has the stock, so he's going to just give that stock to Bob, right? It's like when you're selling a house, you already have a house, so you're simply giving that house to the user. If you don't have the house, then you need to buy from somebody else and give it to the house because you already wrote the contract. So if you in this case, the Sam already owns the stock. So this is commonly referred to as a covered call, meaning I don't need to go to the market and buy because I already have it. I can just deliver the goods that I promised. Okay. So I want to maybe if anybody has questions on this scenario, I would like to pause here and take some questions. I can explain more.
So I have a question here. Here, like Sam wanted to sell at 144 price or something, right? Mm-hmm. In options, what option he has to select? Covered sell, this kind of thing? Is it covered call or covered put? How do he wanted to offer that?
Yeah, so in this case, we said this is a call option, right?
Mm-hmm.
So in your platform, there will be an option, there will be a feature that says sell call option.
Sell call option, this one. So right. If market goes to 144, then only he's going to sell it, right? Otherwise, he's going to get that upfront of $2 premium, whatever it is. Is that right?
That's correct. Yeah. So we'll cover that in the next slide.
Okay.
But at least I just want to make sure this concept itself, everybody is understanding, right? So
Got
Sam
it.
is the seller of the contract and Bob is the buyer of the contract. So from the Bob's perspective, he'll see as a +1, right? And from the Sam's perspective, he's going to see as a minus because he is selling the contract. Think of it as a shorting the contract, right? Is everybody clear on this so far?
Yeah, I have one basic question. Like, so is these terms always about from buyer's perspective?
The right, meaning right to buy, right to sell. So simple way to remember, sometimes the calls and puts kind of confused. Why do we really need two things, right? Because I have delivery and I have the receiving on the other side. It's same, like that's the same thing happening with every stock. So just to give you perspective from the buyer's perspective, just think from the buyer's perspective. Buyer is the one who is paying the money and he is the one who is getting the right. So call, just think of it as a right to buy at certain price. And even for the put, when we talk about the put scenario, right, we are going to talk from the buyer's perspective, meaning buyer who is actually buying the contract. So it's not about buying the stock, okay? We are talking about buying the contract. When I say buying the contract, it's paying for whoever is paying for the contract. Right, so when you are actually, say, buying a house, as an individual, you are paying for the contract. In that case, just think of it as you are the buyer of the contract and you get the right to buy that house at that price, right? When the builder finishes, he's going to deliver the house for that same price for which he wrote the contract for.
Okay.
Okay. No question then? Yeah.
Are you planning to like explain options or like at the end you wanna go and show like any screener you use and how you choose your strike price or just like a basic knowledge on options?
I'll just show you via a few screens as well. How do you look at the option prices in the market and things as well?
Yeah, I mean no, like before taking the swing, like what are the like how you choose and like based on what you buy, are we gonna talk about that?
Yeah. I'm going to talk about some of the basic strategies you can start with as well, and some of the couple of advanced ones as well.
Okay, thank you.
Sriniji, one more question. We're talking about contract. It can be many buyers can go for the same price, correct? Or it's like one to one.
So think of it this way, it's just like a stock market. There will be a lot of sellers of the contracts and there will be a lot of buyers for those contracts, right? So there will be bid and ask as well. So in this case, we took a simple example. There is one buyer and one seller, right? So these contracts are all trading on the exchanges, just like the stock. So in this case, when say Sam is selling the contract, he's actually saying that I'm going to sell this contract for $2, right? Bob might say that, oh, I only want to buy it for $199, right? If there is other seller who is ready to sell for $199, he's going to buy from that contract. Like it's just a bid ask, just like the stock trading.
Okay, thanks.
So think of it just like, so in this example, I was just kind of explaining the concept, but all these contracts are traded on the exchanges, just like the stock market.
Okay, thank you.
And all this enforcement of the contracts is done by the exchange, right? So you have to have the money in your account and everything before you trade all these things. You have enough buffer on your account value, all that.
Yeah, like I have a question here, like which platform is good for trading for options? Like, so which app?
Let's continue this one. Actually, like we can think about other questions because we are
trying to
understand.
So I'll show you a few things that I do, right? Again, it's individual choice. Most of the platforms are pretty straightforward to use.
Okay. Yeah. Okay. So yeah, one more question. Like, suppose like I'm having some stock like Apple. I think like I have an Apple stock, and like I know like this week this is going to fall like at least $10. So like right now for 140, I thought like 135, 130 it will reach because of some news I know. Okay, so which option? Like I have 100
Yeah.
shares with me, Apple 100
So,
shares with me.
so
I can
just
sell if I want.
just hold on to that thought.
Okay.
So let's go through calls and also puts. Then maybe we can revisit your questions, see if we can answer those cleverly. Okay, so let's jump on to the next one. So
I
call
have a
option,
question.
right? Yeah, go ahead. Okay, so let's go through this and maybe I'll open up for the questions at the end of this slide. Okay, so in the previous slide, we saw that stock market price was at 140 when the contract was written, right? The stock price of the Apple went up to $150, right? So what is the scenario? So Bob actually said he's going to buy the stock for 144, correct? But the stock went up to 150. So that means Bob is going to buy the stock for 144, right? Because the stock price went up. Because it might make sense for him to buy at 144 and sell it in the market, right? I mean, make that $6 profit, right? Based off of the price itself. So we have to take into account the commission as well, or the premium that he paid, right? He paid a $2 premium. So even though the difference between 144 and 156 dollars, since he paid a $2 premium, his profit is $4 per share, right? So he paid the $2 and he made $4. So he can either take the delivery of the stock, or he can close the option, make that $4 profit. So there are various ways to closing. Let's not get into the details yet. So this is how the $4 is calculated. Pretty much market price is 150 minus 144 plus 2. So Bob pretty much bought the contract thinking that the stock price will go up. So he spent $2 on each contract, and he made $400. That's like 100% returns, meaning he invested $200. He made the $400, but purely from the perspective of options trading. So from the Sam side, so Sam actually sold the stock for 144, right? But since he actually took a upfront premium of $2, his effective price is 146, meaning even though stock went up to $150, because of the contract, he has to give away his stock for $144. So his effective sale price is 146. He still made a profit, right? Okay, now second scenario, right? So first scenario is good, meaning whatever the Bob was expecting, that happened. So let's look at the second scenario. So the stock price of Apple actually went down to 135, right? So it means Bob was saying, I'm going to buy at 144, but now it is at 135. Does it make sense for Bob to buy at 144? You pay 144? No, because he can actually go into the market and buy it for 135, right? So what he's going to do is going to let the contract expire, and he's going to lose that premium. So the loss for Bob is 200, right? Sam actually made $200 and still kept the stock, right? And Sam can actually write for the next month again, write the similar contract, and for maybe $2 per contract, depending on the strike price. He can write one more, and he can make another 200, depending on what happens following month. He might give away the stock. Okay, so let me go back. So are you guys with me so far here? Any questions on this particular scenario? I'll go to the next one. There's no questions. When will you buy a call? I guess I have the answers here. When you're bullish, meaning as a buyer of the contract. In the previous case, when we talked about the Sam and Bob, Bob is a buyer. He's buying the call because he's bullish, right? And in that 1 month, if the stock went up to like $200, he would have made close to $54 on each, right? It's unlimited, meaning however long the price can go, he's making all that profit. Right? When will you sell a call, right? In the Sam's case, Sam is selling call thinking that, oh, he can get to keep that premium and he's selling the call, right? Or he might be thinking, okay, it's okay for me to sell the stock because I already have enough profits on my stock. So depending on the strategy, whether it's for that revenue income or income plus the profit. Okay, so now the question to the guys who volunteered. When and why do you sell covered call?
Hasti, honestly, I'm not sure on this.
Okay. Yeah, so in the previous scenario, right, the Sam is the one who is selling. Like Sam had Apple stock, and when he sold the call, that's called the covered call, right? So Sam has possibility of just generating the $200 premium, right? That's income generating, right? And he was underlying, right? And he can even sell at a higher than the current price, meaning current market is 140 and he doesn't want to sell at 140. But he wants to sell at 144. So he's kind of saying, I'm ready to sell at 144 in the next month, meaning $4 more than the current price. And I'm getting some additional upfront income, right? If that price never goes above that price, I get to keep that income, right? So just think about it. If it happens like that 3 months, right? Every month you're collecting $2. So it's almost like $6 you are collecting. And then that could affect your overall profit, meaning you're making pretty much close to $6, means like effectively it's like $146, right? Even without selling, right? Your average cost is going down. Okay, I'll pause here. Any questions?
I think Asti, they can't. I have to unmute, but most people prefer questions at the end. Is
Okay.
what I'm seeing comments. So
yeah. Okay, so next question is: can you sell a call without owning underlying stock? So in the scenario we just talked about, Sam owns a stock and then Sam sold the call, right? But what Sam doesn't hold the stock, can Sam actually still sell the call option? Yes, he can, right? So in that case, it's a pure speculation, and it's often referred to as a naked call, meaning almost you're shorting the stock at that time. Meaning it's, if you're just doing the same thing with the stocks, you'll be directly shorting the stock. So you want the stock price to go down, but you don't make money on price going down. You're only just collecting the premium. So this is the same risk as shorting the options. Shorting the stock, the unlimited loss. Okay, so now jump into the put option. As we discussed earlier, put option gives the contract buyer right to sell. So meaning if a buyer of the option wants to sell a stock at a certain price, he can sell it for that price based on the option price, right? So let's take a same case. Let's continue now, right? So same scenario. Sam owns $100 shares of Apple, right? Current price is 140, right? And we know that Sam bought the shares at $100. He has a good profit sitting. Sam knows something based on the news he's following. There is a lot of chatter going on that our earnings coming up. So we don't know what's going to happen, right? I want to at least maybe next 1 month, I want to lock my profits, or I want to get a downside protection next 1 month, almost like insurance. I want to get an insurance for my holdings, right? So in this case, Bob is the other side this time. He's going to offer Sam, saying that, oh, I'll buy the stock from you for $140 per share with additional upfront fee of $4 per share. He's saying, independent of what the price is, like even if it goes to $100, the market price, I'll still buy the Apple stock from you for $140. But you pay me $4. It's like an insurance that he wants Sam's to pay Bob, right? So they enter into the contract saying, okay, Bob will buy 100 shares of Apple from Sam in next month, next month anytime for $140 per share, independent of the market price, meaning the market goes up or down. So we'll talk about why it doesn't make sense when it goes up, but when it makes sense when it goes down, right? So it's just promising that I'll buy the stock from you for $140 independent of the market price. So Sam will agree. So I'm going to give you a premium of a non-refundable $1 per share, right? So in this case, Sam is spending money, right? So in this case, Sam is the buyer of the contract. So it gives the right for him to sell the stock at the contract price. So this is the case, one of the questions that was asked earlier, right? I know some news. I want to just make my product, I want to get some downside protection or insurance. So you're going to pay some premium for that protection. So in this case, $4 per share for the 100 shares. So Sam is the buyer of the contract and Bob is the seller of the contract. Underlying asset is Apple stock, right? So this is a put option. So in this case, Sam actually owns the stock and he's buying the put option for protection, right? So this is commonly referred as insurance put, sometimes referred as a protective put. So you'll hear different terminology based on who you talk to. Okay, possible outcomes. What can happen? So if the stock price of the Apple goes down to 120, Sam can still sell the stock for 140 because he got an insurance for $140, right? But effective sale price, meaning since he spent $4 on the premium, right? He can still sell it for $140. So this is the case. So Sam says, okay, I can actually make the money, and he doesn't believe in Apple anymore. So that's the reason he bought it, right? And he thinks it's going to go further down, so it's better for me to exercise the option. So in this case, since Bob said I'm going to still buy it for 140, so he's going to go ahead and buy it for 140. But he'll have a loss of $16 because it's $140 is the is the strike price, and market price is 120, and he collected a premium of $4, so the effective price is 136. So he has a loss of $16. So now the second scenario is stock price of Apple actually stayed above 140, right? So whatever the insurance was paid, right? So think of it as when you get an insurance for the house, nothing happens in that period, right? The insurer is going to keep that money. Just like that, in this case, since it stayed above, there is no point for Sam to execute the contract because he doesn't want to give away the stock for 140 because the current market price is above 140, right? So in this case, he didn't really use the unused insurance. So the cost of protection is $400. So Bob made $400. All these insurance companies are based off this concept that things will work in their favor. So that's a case here as well. So just entering into trivia, like if you're owning a stock, when will you buy a put, right? So you are bearish on the stock or something is coming up and you have speculation it might go down. So you want to buy a put, right? As a downside protection. Can you buy a put without owning a stock? So in the previous case, if the say, for example, Sam doesn't even own the Apple stock, but he still wants to go ahead and buy the put. Yes, you can, right? You can spend that $4 and then you can go ahead and buy the put. It's purely a speculative bet, meaning it's going to go down and I'm going to make the money when it goes down, right? It's almost like doing a short with a very limited loss, meaning in this case, he's only spending that insurance money of $400 with potential profit of maximum profit of the price of the stock, right? Price of the strike price, meaning if it goes to zero, you can make the maximum profit of the strike price. So when will you sell a put? Like in the Bob's case, he's selling a put thinking that the stock price would remain above the current options, the strike price, so that he doesn't have to buy it at the marketplace, at the strike price, even though market price is lower. So pretty much in this case, the seller is bullish and is going long stock at a lower price, meaning if you end up buying the stock from 140, you're actually going long at a lower price, right? Meaning you're getting it for $136 instead of $140. Some people use this for averaging rather than buying everything at one time. You can just start selling the puts and you can start buying the stock. So maximum loss selling a put is because maximum loss is you end up actually buying the stock for whatever is the strike price is. So maximum loss would be that strike price. Okay. So next is terminology. You hear this in the money, at the money, out of the money. So in the money means the call for the call. So think of it this way. If for the buyer of the contract, if it is profitable, meaning whatever is the price above the strike price, it's in the money. Like for example, in the example that we were saying, when the price was at 150, right, and the strike price was 140. So the difference between the market price and the strike price was $10. So that particular call option is in the money, right? So if it is on the other side, meaning the contract doesn't have a value, meaning then it's out of money. At the money means, so whatever the strike price of the option is, if the current market price is at the same place, then it's referred as at the money. So depending on whether it's a call or put, so in the money and out of the money changes. So let's quickly go through a few examples here. Like let's identify in the money, at the money, out of the money. So if the current market price is 140 and the strike price is 130, the option strike price is 130. So then in the money would be, because it's $10 more, right? If it's a call, so it is in the money, right? And for the put, it's not in the money because market price is above the strike price. So other scenario is market price is less than the strike price. So in this case, call has no value, right? So this has meaning actual intrinsic value, actual difference between the market price and the strike price. That's below zero, right? It's -10. So call is out of the money and the put has in the money. So option pricing is determined by various factors, underlying asset market price. When I say asset market price, depending on the stock price, right? For example, Tesla is trading at 700 because it's the value is, the price is high. Option, if you look at the option prices, they're also very high, right? And the strike price of the option itself, if you are depending on the strike price, the value of the price of the option also changes because the difference between the market price and the strike price, right? And there is a time to expiration. So for example, the same example that we were talking earlier, where Sam and Bob were writing contract for 30 days, 1 month, right? What if you have to write the contract for say 6 months, 1 year, right? Of course, seller of the contract is going to ask for more premium upfront because he's going to hold the stock for longer. So it's important the time to expire. Look at the time to expire as well. I can even get by for example, the scenario of the put where Sam was buying a insurance, the protection for the stock. If you want to buy that for say 1 year, right, you have to pay more premium, right? Versus 1 month. And the asset volatility. So asset volatility is if the stock price is going volatile, meaning it's going up and down quite a bit. It's a lot of volatility and a lot of volume. There is a volatility price embedded into the option price, not just the intrinsic value. So you're going to see that price to be higher. I'm going to just walk you through an example in finance.yahoo.com so that you can understand. So there are a few other advanced things that get into when the options are priced, like rate, risk rate, and all those things. So which we don't need to worry about it. Even I don't understand all that aspects. So let's not worry about that. Okay, so let me go to. So any brokerage that you are using, so you'll be able to see the option pricing, but as Yahoo is kind of a standard tool that a lot of people use. I'm going to use a standard. I see that like in our ThinkSabio, CPNG is one of the popular stock a lot of people talk about. So you guys can see my see the finance.yahoo.com, right?
Yes, Hasti.
Okay. So if you go into stock here, go into options, click on options. So here you can see that there are options for September 17th expiring. This is the expiry date. Okay. And October 15th. So these are all monthlies, right? For this particular stock, there are only monthlies being traded. Okay. And you can see that it's kind of spanned to every month, right? They expire every third Friday of the month. So tomorrow happened to be the third Friday. So that's why it's tomorrow date here. Okay. So we talked about in the money, right? Which usually is closer to the current price. right? So even though it's in the money means they'll just say, kind of show you a little bit out of money as well, but let's see here. So these are call options. See the strike price here. So you can actually trade that when you log into your platform, it will show you similar thing. You can actually look for options on each symbol, and you can actually start trading this one. So here, for example, last trade price was 1440, right? You can see that price is actually going down as it gets closer to the current. So it's 29.41. So let's assume that at the money is $30, right? So in this case, if we are selling, somebody is selling a call for $17.50 and the market price is $30, so the difference is $12.50, right? So somebody is already making money. Like if somebody wants to buy this contract, that means somebody is saying that, oh, I'm going to sell you stock for $17.50, right? But pay me the difference of the current market price, plus if there is a lot more time to that expiry, I need some additional fee. In this case, it's very close, just tomorrow, right? So you can see that it's very close to that price. And the bid and ask is a little out of whack because it usually should be the difference between these two plus a little bit of premium. And if it's for $20, the difference is $10, right? So you can see that $10 with some premium because there's 1 day still left. So anything can happen. Similarly, if you look at this 2250, it's kind of close to 750. And at $30, it's only 15 cents, meaning whoever is selling this or asking for it, they're expecting not to go above $30 by tomorrow. And you can also see this volatility. We're talking about implied volatility. What is the volatility? How these are being traded? So this is what we're talking about, right? So how much volatility is there, right? And for example, if there is a $50 option, what is the probability of stock going up to 50 tomorrow? It's very less. So that's why it's almost, you can see that bid is ask is like somebody's asking 5 cents, but the bid is like almost zero, means nobody is actually willing to buy that at $50 one, because probability of that happening by tomorrow go to 50 is almost zero, right? And the open interest is meaning there are so many contracts that are open right now. So there are a lot of people who sold the contract. They're all going to make money here, right? So depending on at what point they sold these contracts. Are you guys still with me? So let me quickly show you in the Robinhood. This is the size account. Right now we don't have any balance in this, but I think they should still let you. For example, we have this stock here, right? Nike. So we can simply say trade Nike options here. And see here, it's pretty much showing all the strike price, right? It kind of gives you other options. What is a break even, the things as well, based on the current market price. So current market price is 13 cents. Like if you actually buy it, so as a buyer, right? If the price is above $160, then it's a break even, right? This kind of gives you what is the percentage rise has to happen to get the break even. So it kind of gives some statistics. So the key is the strike price 161 if you want to buy or sell. As a buyer, you need to spend 13 cents. The seller will be making 13 cents, right? If you tomorrow, if you think it's not going to go beyond 160 in this case, you can sell this and make 13 cents on each. So you can simply say, click here. So in this case, we are doing a buy, right? Because we selected buy here, right? So you can say that your total cost is $13. The same concept that we just talked about is the maximum profit is unlimited because you're buying the call in this case. If suddenly if it goes to $1,000 by tomorrow, then yeah, you're making a lot of money, right? Your maximum loss is $13 because 13 times 100, right? The break even is it has to go to $160.13. If it doesn't go, then it's pretty much worthless, right? And if you're as a seller, you just do this on the other side. Okay, then let's open up before I get into other details, because I just want to make sure there are any open questions or other things the team wants to discuss.
Sure, Hasti. Yeah, everybody can speak if you have questions.
Yeah, so one other thing
One
I
at a time.
quickly want to show you is, so this is one of Sai's account, right? So you can see in the account, we have been actively doing the trading, where selling the calls and all that. You can see that some of the calls we ended up actually selling the stock because it went up, right? And there are some speculative that even the AMC went up quite a bit. So we speculated that it will come down eventually, right? So we sold calls. So you can see some of the gains, and we do have some losses, but the overall theme is to have more wins than losers. So that way you can make money overall. You can see we are selling the call here, and even the bond reversion scientific, it got assigned because we actually sold a covered call for this one. The price went above whatever the option that we sold. So just to show you guys some of the trades that we did. I know it's a lot of stuff. So let's go ahead and open the floor, and maybe based on the questions, maybe I can navigate around and show you the things.
Can you go back to Robinhood if you don't mind?
Yeah, sure.
Yeah, the same example, right? The Nike. Here we're talking about the share current value is 140, 157. But why are they, yeah? Can you click on the buy instead of sell? Yeah.
Right. So let me reload just so that it clears up. Okay, go ahead now.
Yeah. Now the Nike value is 157.60, right?
Yeah.
Previously, I've seen for buys, right, somewhere around 140 also. Like, can we buy lower than the existing thing?
Yes, you can, right? So let's take that example. So let's go to, I think, I like Yahoo. Let's go here, right? So let's, okay, so these are all the options that are trading by various strike prices. So current price is 157.60, right? Just like we saw in the Robinhood, right? So you can see that there are options trading from $95, right? But you can see that the premium is more, meaning, so think of it as, right, if you're getting a option and you're buying an option, $95 strike price, that means somebody is willing to sell you the stock for $95, right? But the current market price is already 157, right? So that difference between the marketplace and the strike price will be already embedded in the price. Plus a little bit of, since there is only one day, little bit of additional time value in it. So in your case, you're saying, can I buy for 141? Yes, you can buy for 141. Let me see in the here, maybe there's an option to see. So that one is a deep in the money.
You can buy it. Actually, you can go down actually, then it shows 140.
Oh, they have it other way around. Okay,
Yes.
got it. Thank you. Yeah, so here.
Now that means, am I already in profit? Like if I buy this, I did not understand the concept here.
Okay, so let's go here, right? So if you buy now, so let's take 141, your example, right? If you buy now, you are spending $16.98, right?
Yes.
So that means a seller is going to sell the stock for you for $140, correct?
Mm-hmm.
But you already spent a premium of $16.90. But sorry, don't go to the last. Look at the bid and the ask, right? Meaning, since you're actually buying, you need to look at the ask price, right? So that means you have to pay that guy for $17.80, right, to buy this contract.
Right.
So if you sum up this 140 plus 1780, right? So you can see that it's greater than the current market price. There is almost 20 cents more than the actual market price.
Okay.
Because you're not making profit. You're still spending the 20 cents more, right? But you're paying a lot more upfront, meaning you're from your pocket, you're paying a lot more, right? It's a fixed amount, but you're paying more, right? But as it gets closer, the 20 cents actually gets bigger and more. For example, 151, I think the markets are closed now, that's it's kind of out of whack, but usually when it goes closer to the at the money, though that time value as well as other volatility factor that gets used to calculate the price, that will be a little bit more like. So in this case, there is 20 cents. As we keep going, it will be like 24 cents, 25 cents, 30 cents as it gets closer to this one. But once it crosses the actual market price, it will start going down again. Because probability of that event happening is less. Because if you buy this one, 161, you can buy it for 15 cents. Right? But the stock has to move almost $2.40.
Okay.
Yeah, but if you know something, right? For example, so let me show you other one. These are all September ones, right? Oh yeah, for example, oh yeah, other thing I want to show you, right? So when we looked at the CPNG, it was only showing monthlies, but here you can see that it's actually showing weeklies too. So not all the stocks trade weeklies, but if you're into trading weeklies, if you want to do the trade, you don't want to just do it for 1 month, I just want to try for the weekly ones, you can actually try the weekly ones. Because there is a little bit more time for a week, meaning compared to 17th and the 24th, that additional premium, the time value actually goes up. So same thing, you can see that earlier we saw that the ask price was 1770, right, 1780. But here you can see that ask price is 1855 because there is more probability that it will stay above 157.60, right? Or could be other side as well. But since we are looking at the call, so that's why that is a little bit like, and if you look for say October, let's go to October as a month, October 15. So if you look at 140, right, it's a little bit more, right, 1890. So further you go away, so you can actually see, you can see the options that are all the way up to Jan 23, even like there's one here, right? But nobody's trading at this time. Not much happening, right? This one is there, right? You can see here, $140 one is almost 31. Because somebody is promising that I'll sell it for 140, like even all the way in January 20, it's almost 4 months away from now, right? That's why they are getting almost compared to the current market price. If you see, total here is 170, almost they're getting $14. They're asking additional $14 because there is a lot more time period between now and the expiry.
So, Srinivas, question for you on this. So when you sell a covered call for the leap, like what you're telling me right now is a leap call, right, for January 2023?
Yeah.
So if you sell that, like for example, as you said, right, if you have 100 stock, not a naked call, but say like, I mean, you are doing a call, okay, covered call. So that point, like if you sell it for long term, like I mean, as you said, like January 2023 for 140 call, so you collect the premium of 31.95. Okay, almost $32 you are pocketing.
Right.
So do you need to wait till to sell the stock? I mean, that means you're locked those 100 stocks till January 2023.
Okay.
Or so you could sell in between, like I mean, so what is the scenario in that?
Okay. Yeah. So let's start. That's a very good question, actually. So yeah. So this is kind of a leap because it's almost 4 months from now, right? Let's take the one that is actually closer to the current market price, so which is around 155, right? So you're almost getting what, $24 right now, right?
Yes. Okay.
So which is going to be, and it's a covered call because you already own the stock.
Yes.
So let's talk about two scenarios. Okay. So one is if the stock price keeps going up. Okay.
Okay.
So in 1 month from now, stock is trading at say 180. Okay.
Okay.
So this price is going to go up. Meaning
Yes.
if you try to close it at that time, you are, so your total here is almost, let's assume it's $25. That means effectively you are getting $180, right?
Yes.
If it went all the way to the 180, they said, okay, I want to just close it to 180. But the problem is there will be some additional premium because it's the time period left and it's actually moving, right? So you might lose like additional $2. So the other thing is these options you can actually close at any time. You don't need to hold it till the expiry time, right? For some reason you thought, okay, I can just go ahead and close it or close the option, right? You can either just go ahead and close the option and close the stock, then you're pretty much exiting at that point.
Got it.
Right? So other scenario is say the stock went to $110, right?
Okay.
So now what happens is this will come down to, I would say like $6 or $7.
Okay.
Because the probability is always probability of the 155 happening is calculated based on the current market price, right? Since the current market price is 100, so it's a long way for it to go to 155, right?
Okay.
So it might come down to $7. You can say at that point, okay, it might start going up again. I want to go ahead and sell the contract for the $7, right? That means you made a profit of $18 on the contract itself.
Yes.
So you can pretty much trade the contracts. So when stocks are in the range bound, when the stock is kind of moving within certain range and you kind of speculate, okay, it came down so much, my option is kind of becoming out of the money right now, right? You can see that out of the money ones, for example, say 180 ones or 190 ones or 1220 is much less compared relative to the current market, right? The same thing happens when it actually falls, so that you can just go ahead and close the option. Okay. So I do that quite often so that I can log the profit because I don't know, maybe in the next 15 days, it might again come back up.
Got it.
So that way I can still keep my my underlying stock. And when it goes up to 135, 140, I'll again write the call option. Right?
Got it.
I keep on doing that so that at some point you might lose the stock, which is okay because I already made some money. And this is actually helping me to reduce the overall averaging my the overall cost of the underlying as well, right? If I see it that way.
Got it. So by looking at this, okay, so based on your experience, so the leaps are better or short term? I know like the stocks are there, each stock is different, behaves, and which one is the better, in the doing the leap calls or like short term or so what is the best for for all? So
certainly if I can recommend, but it all depends on the individual. Yeah, so leap stocks, you're kind of getting a lot more premium, right? And then you're expecting not to hit that the price at the time of expiry just below, right? So that you can keep all of the premium, correct? But again, at the same time, you're kind of holding on to the stock for long term. At least myself, I do a lot of monthlies.
Okay. So no, I'm asking like when you have a stock like that is covered call, when you write it like that is monthly you're telling, but when somebody has like buying a call, so like in the case of like a Bob, so where he's buying a call, right? So that case is also like, he can buy leap or he can buy short term, right? Yep. So which one do you recommend in general?
I recommend monthlies or weeklies because you're most of the time when you're buying a call without actually owning underlying, meaning you have an interest of owning the underlying eventually, but at this point, when you're buying a call, you're just speculating that the price is going to go up, right? So if you're buying a leap call, then you're spending a lot more premium right now. You're pretty much putting that money in there. Of course, if the stock price goes down, yeah, you're making money. But my strategy would be, I would kind of spread that premium across maybe multiple doing monthlies or weeklies, right? And SPY, like some of the indexes, like the SPY, IWM, some of those are actually much better vehicles or derivatives to trade on, because the volume is very high and they're kind of almost a range bound, because S&P always, and it's growing slowly, but it doesn't suddenly next day it doesn't grow by 20-30%, right? Unlike individual stocks.
Okay, thank you. I'd like to others to ask the question. Sorry. Thank you so much for answering all my questions.
Srinivas, can you explain a little bit from the naked call perspective? Like, let's say, like I don't own any of the Nike stocks, but I went ahead and bought this $155 call for $24. $24.20. And then now the Nike price went down to 110, where the price might have gone to from 24 to $7. So at the end, like, do you recommend selling it like as soon as it goes down a little bit, or like how does this naked call work? Because I don't own any of the stock.
So in this case, did you buy the call?
Yeah, buy the call.
Yeah.
Yes.
Yeah. So when you buy the call, you make money when the price of the stock goes up, right?
No, when it goes down.
No. When you buy the option, right? So for example, in this case, say 155, current market price is 155, and you bought a call, say for 181, you are actually spending money.
Right.
That means you are putting, in this case, 100 means 1,300, 1,385. You are spending money.
Right.
With an expectation that the price is going to go up.
Right.
Right. So, yeah, so it's up to you, meaning what is your criteria? Like, what's your exit point? If I make, say, $300 of, meaning, for example, the stock went up to 165 in next 1 week, 2 weeks. So you can right away close it, because this value is going to go up to say $18, right? You can just go ahead and close it. But your speculation is the price is going to go up. At what's the exit point where you want to exit? It's an individual choice, right? So usually for this kind of bets, I would, if it is in my favorite, if I make like say 40% profit, I usually exit like even 30%, right? I'm always looking at, okay, I spent 1,385, right? So off if I make 20 or 30%, that's good for me, right? Because think about this, like the investment of that, and if I'm making that money, if I'm consistently able to do it, or in a year, 12 months, even if I have 6-7 wins or a few losses here and there, effectively, if I have like 5 wins, I'm still making maybe 20% return, 25% returns, right? Maybe more.
So there are a couple of options, right? When we do this call, like buy to open or buy to close, sell to open, sell to close. So what are those? Like, I'm kind of confused on these 4 options, like buy to open, buy to close, sell to open, sell to close in the call option.
Right. So buy is a buy, meaning, right? So when you buy a stock, you buy the stock, right? And when you want to sell the stock, you do sell to close, right? Opposite action is you bought something and you need to close something, right?
Right.
It's the same thing, right? So in this case, say if you buy a contract, you sell the contract to close that.
Okay.
Or like in the other way would be, if you sell the contract, means you're shorting, right? It will show up as -1. So just like when you short a stock, it will show as a negative number. When you sell the contract, it will show as a negative number. Right? So you sold it already, and then you need to buy it to counter that thing to make it 0, right? Just think of it opposite actions.
Okay.
So buy means, think of this, buy to open means you are opening a new contract. That means you are actually paying a premium. Sometimes you hear this term as a debit action, meaning you are actually losing out when like the money is going out of your pocket. It's a debit action from your pocket, right? And when you're selling a option, that means somebody else is paying you. It's a credit event, right? So there are other strategies like credit spread. We'll get into maybe those details down the road, depending on how others want to maybe think about the next sessions.
And here I have a very basic question here.
Yeah.
So when you said I buy a call option, so I have a 1 week expiry time. I mean,
Yeah.
next Friday till next Friday. So I can sell it anytime.
Yes, you can sell it anytime, right? So there are one gotcha though. So when you're selling something, there always need to be a buyer when you're closing something, right? Just like the stock market, right?
I see.
So that's why it's the other important thing is you want to pick the things that have somewhat have volume. Like the Nike is a very good thing. It has a lot of volume here, right? So you can always trade actually. Between the bid and spread is also not much, right? So there are even the coupon is good, right? There are some stocks. If you can actually tell, like if you go to the stock, for example, summary, if the volume of the stock is high, most of the time you will have even the options are trading quite high. Like even if they have weeklies are trading for that stock means there's a lot of volume in there, right? Available, so there won't be a problem in closing.
Okay, thank you.
Hey, Srinivas, one question on the strike price. Yeah, so how should we select the strike price? It should be very close to the current market price, or like it should be high or low. How do we determine that one?
Okay. Maybe I'll explain one scenario that I use quite often. So when I want to buy a stock, right? For example, let's stick with Nike, right? So current price of the stock is 157, okay? And it has come down. Let's assume it was at 170 or 180 and came down to 157, but I'm still not sure if I want to enter at this point, right? But I'm comfortable maybe 10% on that. Again, it's my individual. I'll just look at the conditions of previous, like what is the 52-week movements and few other things. Or are there any news going on? Like you also want to take into account, are there any news coming up? So usually what I do is if I want to buy the stock, I don't actually buy the stock in the market, right? What I do is, okay, I'm comfortable buying the stock at $155 in this case, right? So far we were looking at calls. So let's go to puts, okay? So what I do is let's go to maybe the next month. So it's just tomorrow is to close. There won't be any premiums. So you can see that somebody is giving $4 for this $155 one. Like if I sell a put. Are you guys with me? So selling a put, right? Meaning I am selling a put means I am saying that I'm going to buy the stock for 155 independent of what the stock price is, right? Even if it goes to 150, else I'm going to buy for 155, right? So I collect this premium, right? That means my average price is now 155 minus 4.25. It's close to 151.
Yes.
The next 1 month, if it comes down to 150, okay, I'll get it for 155. But it's better than me entering at 155. Right, because I got it much cheaper. Right, if the price stays above 150, I get to keep this $425. So the way I do it is like sometimes when I want to buy, recently the trade I did was like the CPNG, right? I said, okay, I'll go long on 200, but the way I want to average is rather than directly buying the stock at the current market price, I started selling the puts for 27, 28 as the price is coming down. Okay. So that way, okay, if it eventually comes down, anyway, I wanted to buy, but I'm actually automatically already averaging today, right? With the lower price on top of it, I'm also adding some premium. So my price is actually coming down quite a bit.
But by doing that, are you kind of saying that, for example, you said $27, you're selling puts for $27. Like if it never comes to 27, right? If it comes to like 27.50, so now you won't be able to, because you already sold the puts, so you cannot buy it for 27.50. You have to wait for it to reach 27, I guess, right?
Yes, if it is, never comes down to 27, right? I'm not going to buy it at all.
Okay.
Meaning I don't have to buy, right? But I already collected a premium, say $1, right? Even if it comes down to 27, I'll take it, but my effective price is 26, right? But if it doesn't come there, however, whatever the premium I already collected, it stays with me. But since I said, like, I kind of split it, like if I want to buy 200 shares of something, I'll go ahead and buy 100 in the market already, right? And rather than waiting for the market to come down to average, I'm already saying, okay, I'm going to just write the option today if it comes down, so that I'm already averaging it. But in case if it doesn't come, that's fine. I already have $100. That will help me with my long position if it goes up.
Okay, makes sense. Thank you.
It's a way of trying to average, but at the same time, yeah, sometimes you may not be able to average because it never hits that. But since you collected that premium helps you towards average.
SRINIVAS, this is a great session. Can you do us a favor? Can you take a GameStop example and explain to us on what happened? We high level majority of us are aware of, believe, I guess. Can you just explain to us about GameStop situation?
Yeah, so definitely. So let me see what's the best way to do it. Maybe what we'll do is, so let me go here. So I'm going to just start a new chart and we'll just go through the example, right?
Hey, Srinivas, just quick question.
Yeah.
Can we predict future based on this option, or how is going to be behave in the future? Stock are going up or down?
I won't call it as a predict, but you can say what people are speculating, right?
Yes.
So meaning, if you guys know, there are some, so like even TDM retrade, I don't know if the Robinhood does that. If you look at some symbols, you'll have some notification saying that, oh, somebody bought like 5,000 call options. Like I think there's a binging or some site like where they actually have that all the time, right? So based on this open interest, for example, if you look at this open interest here,
yes,
right? So this kind of says that, okay, a lot of people are expecting it to stay above 140, right? So this is based on already existing open interest. But if somebody does like a big chunk of buy, somebody buys like say 20,000 calls, sometimes you get that notification. So maybe I can post examples, some of those examples in the ThinkSabio channel, right? So that kind of indicates that somebody is predicting something, right? And they also tell you that they will call it as an unusual options activity. They kind of tell, okay, somebody is predicting that it may go up or go down based on their option, but you can just, it's not a real indicator, but you can say, okay, these people are expecting this. Sometimes what happens if it's a big enough guy, I have seen it actually happening. It's kind of getting close to that point, so that guy still makes the money, doesn't lose, and still makes the money on the options. It may not be all the intrinsic value that he was expecting, but kind of moves there and moves in the opposite direction again. I have seen that happen.
This data is available publicly or confidential?
No, it's all public. So if you search for unusual options activity, you'll get a lot of references, like if you're following some stocks or things like that, right?
So this Yahoo website, it will tell that one, open interest is,
Yahoo doesn't tell it. Actually, I know Ameritrade has, like when you are looking at a stock symbol, there is an activity in the news, it will show up there. But I would just even just Google it out.
You said that it's publicly available, no? So
all the data is publicly available. Yeah. Somebody is actually looking at, because all these transactions are public. Somebody is actually looking at all these transactions and coming up with theories saying that, oh, somebody bought this for this one, so that means they're expecting the stock price to go up or down, right, by this date, because all these options have an expiry, right? This is a good indicator in my view. At least you can see what other people are speculating. So based on that, you can make a call whether is it the right time to enter or not, even if you're trying to go long.
Okay, I will ask more questions. Go ahead with the GME stock. Okay, sorry about that one. Thank you.
So no problem. Yeah. So GME stock, do you guys understand the short squeeze?
No.
Okay. So let's going back to our example, right? So GME was initially was at, say, what was it? Like it was $30 or $40, right? It was trading at $30, right? And lot of hedge funds, let's call it hedge funds, started at 30, let's assume, okay? So I think there was a report saying that GME, GameStop, isn't doing good. They're expecting it to go down. So hedge funds are going to make money if it goes down, right? Below 30, right? So all this, they saw that, let's go here. It's another important factor that I want to show you here. GME. Open short interest. Statistics.
Sorry, one question. When you say shorting a stock, what exactly do these hedge funds do? Do they do what do you call buy puts or something, or what exactly they do in that?
So two things they can do, right, based on so far, meaning they can directly short. We don't know exactly what they do, right? Let me write this. Short. So we're going to refer this as direct from the direct stock itself, right? I can do it that way. Or what can I do is sell calls, correct? So remember, if I do the sell calls, I am required to deliver the stock at whatever the strike price is. Let's say in this case, hedge fund used one of the strategies or both, right? Combination of both. Are you with me so far?
Yes.
Okay. So if you go to GME stock, any stock, if you go into statistics here, so one important thing you want to see is percentage of the short, percentage of the float. So that means out of 100 stocks, there are almost 20 stocks are shorted. So if this is high, that means a lot of institutions are shorting, or individually, we don't know who it is, but most likely hedge funds and other people, right? So if you look at like Nike and others, you don't see that many shorts. So you can see that float is only 1%, right? So all this Reddit crowd, if you look at most of the stocks they're targeting, so they're targeting the ones that have the short float high, like other one is AMC. So 18%, right? It's very high, right? So when they're short, either a directly a stock or by selling the calls, so they're saying that they will give the stock for $30, independent of what the price is, right? So meaning they'll make the money if the stock price goes below $30, right?
Hey, sorry to interrupt you. I have a quick question. What do you mean by starting direct stock?
Meaning in the market, like for example, here, if I go to Nike stock price, let me go to the Nike. Second, directly trade Nike, right? Buy or sell.
Okay.
Meaning whenever you're trading a stock, I don't know if you notice, there are two options. You get buy Nike or sell Nike. Even if you don't own the stock, you can sell Nike.
Oh, okay. Okay, got it. Yeah.
Meaning you are expecting the stock price to go down, so that you're actually selling it. You don't own the stock, but you are selling it. The process is you are selling it right now for 157.60, And if it goes to $140, right, you are going to buy the stock. The way that happens is when you short the stock, meaning if you don't own the stock, think of it as you're borrowing the stock from somebody else and selling it for 140, 157.60. And when it goes down, for example, it went into 140, you're buying at 140 and giving the stock back to the owner who let you borrow, right? That means you pretty much borrowed it and sold it for less, so that you made that money, right? But if the price goes up to $180, then you need to, if the borrower says, oh, give me my stock back, then you need to buy at the market price, right? At $180, and meaning you're going to lose that money. What the difference is to give the stock back to the borrower. Borrowee. Yeah.
Is there any particular time to give it back the stock?
No. So that's other, like if you're directly shorting the stock, there is no time left, just like long. As long as you have enough money in your account, your value of the account is can handle the losses you are incurring. Meaning,
no, today if I do the short, when have to give it back the stock? Tomorrow or after 1 month or 1 week?
It can be any time, it doesn't matter. So if I short it for 157 today, right? If the stock went up to say $300, okay?
Yes.
So that means you have a loss of $150 on each stock. If you have a $100 stock, you have a loss of 15K, correct?
Then I will wait, it will come to 100.
Yeah, so yeah, you'll have to wait, but it keeps on going to say $1,000.
Yeah, as long as margin supports, I think they don't.
Yeah, because as long as you have that account value supports that loss, because brokerage is going to expect you to buy at the market price. For that, you need to have the money in your account, right? So that's what they're looking for. As long as you have money in your account to handle that, yeah, it's fine. They don't touch your stock.
So it means that we can do the shorting in the margin account, not in the cash.
Yeah, in the margin account. But if you have enough cushion in your account, it has to be a margin account, and you need to have enough cushion in your account so that overall account value, when they liquidate your account in case of worst case, it should cover that loss.
Okay.
Okay. So let's go back to that scenario, right? So direct stock or selling the calls, right? Selling the calls have the same effect, except that they collected some premium, right? So now the same scenario, say the stock went to $60. So they say they shorted, I think there was a figure that was going around, was close to $1 billion stock they shorted, right? So that's why you see that percentage. If it went to $60, meaning it almost doubled, right? What is the loss at? Loss doubled, right? So loss would be, if it goes to 60, loss would be 2 billion, correct? Meaning this hedge funds needs to have that much cash in their account to cover, right? So GME went all the way to, it was like, I think almost 470 or so, right? That's almost 6 times of this, right? So it's almost 12 billion loss, right? So what will these brokerages will start doing is they will start closing the stock, so that they're afraid that, because if this hedge funds default, it's on the brokerage firms to cover that loss. So as the stock is going up and up and up, and that's called a short squeeze. So what happens is they're trying to buy, like to close, for example, if there is a 1 million stocks short, to close that, somebody has to buy 1 million stock from the market, right? That means the price of the stock will start keeping going up and up and up and up. Because somebody is saying, I want to buy, means of course sellers are going to increase the price. So it's kind of short, they call it a short squeeze. Does that explain what happened there? So in this scenario, I had some cushion in my account, right? Some balance. So I sold a call at, when it was going up and up and up and like that, I sold a call at $360. And somebody paid me a premium of almost $40, right? So meaning I made $4,000 on one call, right? My expectation was it will come down because I know that the regulators will all kick in, and they're going to at least try to get it down, or eventually things will come down to normal. So at one point I had a loss because when it went to $480, like almost I had a $120, means almost 12K loss, but I had enough cushion in my account. I said, okay, I'm going to just do $80. So eventually it came down to, I think 170 or 180. I get to keep that $4,000. Are you guys clear on the scenario now?
Yep.
Okay. That's one. Any other question? Maybe I'll cover a couple. I know it's already 9:40. I don't know usually.
Yeah, so I have a quick question if you don't mind answering.
Yeah, sure.
Yeah, so this is just a practical scenario. This is a situation I'm in. I have about 100 shares for Ford. I bought it like earlier this year when it was around like $11. And then I bought an option which expires actually tomorrow. I did a $10 with a strike of, so I paid like $4.50 premium on that call. So right now my call is out of the money, but I was looking at the chart for Ford, and it looks like it is coming up in last 2 or 3 days. So in this situation, do you suggest to buy the call, which I did, and in that case, my average would be around like 1350 aroundish? Or should I just take the loss on this, let it expire and not buy the call, not exercise the call?
So you said you bought a call, $10 strike price?
Yes, $10 strike price. I think the premium was $4.50. So basically $4.50. And if I'm exercising the call right now, I guess it would be like of course I'll pay the price I would pay would be $4.50 or the $14.50 rather.
So let's look at the based on the current market condition, right? So today, if you buy the stock in the market, right, you can get it for $13.40. Right? If you exercise your option, you are actually going to buy the stock at $14.50 because
that's correct.
You paid a premium of $4.50, right?
That's correct.
So in that case, I would rather because it's simple, right? So because I get it for cheaper if I directly buy it in the market rather than exercising my option, right? It doesn't make sense to exercise the option. I would not. So I would simply buy it, and if I really want to average it out, I'll average in the market, and I'll close that option. You might have some few. It should still have some value in it because you bought it for it should have at least close to $3.50, correct?
Right. So I think at this point, I have a loss of $140 on that particular call. I'm looking at.
Right. So there is intrinsic value already of $3.40, right? And
right.
you paid
So,
yeah.
Yeah, that's correct. Yes, I paid $4.50 on that. The market value of my call is $3.40. So I have a loss of $1. Actually, I think I may have bought it for $4.80 then. So I guess I have
you had
a
loss of $140, right?
$140, yes, yes.
Yeah,
so,
I would, if you want to go long, I would close the option.
Close the option. So I was thinking like maybe I can save that 150. I mean, save that 150 and go long. So maybe if it ever recovers to like $15, $17, and I was looking at the chart, it looks like it will recover. So in this case, would you suggest like closing, or you suggest, and if it suggests closing, like why, and not to exercise?
Yeah, so in this case, you're in the money because your option is still in the money, right? I'm just thinking, so does it make any sense? Like if you exercise, so you're going to, yeah, so the thing is, I'm sure since it's expiring tomorrow,
Mm-hmm.
Right now, I think only value left would be pretty much close to the intrinsic value, right? There is no time value left anymore for 5 cents.
Right.
If it had been a
Right.
little longer, then I would have thought about, okay, I might be losing a lot more money. But if there, for example, if the option is trading at 350, right?
Mm-hmm.
And
Right.
if I
Right.
close my option, I can close it for 350, but I can buy the stock for 1340, means I still have 10 cents advantage. But there is a
Okay.
10 cents turns out to be $10, but you are going to pay like 65 cents for the option cost. So you still have $9 advantage. So I'll leave it like to you, like it's $9 worth doing this, or but you have to time it accordingly, right? You kind of have to do all these things in tandem to even get to that $10 or $20, whatever is the thing that you can make, right? So,
Or would you suggest rolling it out? Would you suggest rolling the option?
Hasti?
It depends on the individual. Rolling is all based on what you're expecting
Okay.
going forward, or you're just taking the money out here and you're just rolling to the next one. But it's
Okay.
this option itself, if you want to just owning the stock at this point, I would just think about, okay, what is the advantage if I sell and sell the option and buy it? Right? If I can maybe get like 20-cent advantage, then it's like $20. Is it worth my time? It's like an individual choice at this time. If it's like
All right.
it's like a $1, then no brainer. It's like $100, right? If it's below 10, some people are, it's just $10. It's zero. But depending on how many contracts you have, you might want to do that.
Okay. All right. Thank you.
So, Srinivas, this is Naren. I have one more question. Let's say like I bought a Amazon naked call like last week, and like for a higher price range. After that, the Amazon went down deeply, like where I almost lost it. So during that time, like sell even if let's say like I bought it for 3,000 and I lost almost 2,500. Do you still recommend selling that so that at least I will have the 500? Or is there an option to buy them? If there is an option to buy them, then I need to buy at $3,000 of each share into 100, right?
So,
if I want,
Naren, if you don't mind, let me pause here. So, Hasti, one question from all of the users: do we have any more concepts to cover, or is it going to be question and answer? That's one.
I don't have any concept, but I have a couple of interesting scenarios just on the cover. I just go over so that I kind of give you guys some thought. Meaning, some of the guys looks like doing some option trading already. I would like to just go over a couple of those and see. Maybe that would be a good thing to know and see how others are doing.
Yeah, another one is I know, no disrespect to anybody here, but personal portfolio questions, everything. Others are here to learn what we are trying to share our concepts rather than personally how it will impact the stock price for your portfolio. So let's see if we avoid that kind of questions. Again, in the interest of everyone and on everybody's ask. This I just want to say it loud here.
So also, Srini, it would be great for the beginners. What would you suggest?
Yeah, so let me just go to, I had a couple of charts. Maybe so we'll continue to do this. Maybe we'll concentrate on beginners, right? So at this slide, can you guys see my screen? So the beginner option strategies, right? So my recommendation would be, most of you, based on what I noticed in the ThinkSabio channel, is that most of you already own the stock, right? I would start with out of money covered calls, weeklies or monthlies. I know sometimes you might lose the stock, but that's why I keep it short, 1 month or 1 week, and just get some experience. Because you're not really risking much. And also just do it with the ones that you have the unrealized profit. Like even if you lose the stock, you still made money, right? That would be my recommendation for the beginners. And when you're buying a stock, when you want to buy, for example, CPNG, right? Do the strategy of selling out of the money put option, meaning the CPNG is trading at $30, which is the case. Just try to sell out of money rather than buying the stock, or maybe buy 100 of CPNG stock directly. And for the next 100, just sell a out of money put option, say for $28, right? Just get that premium. So that you just understand, and both are on the sell side, but at least that gives you the idea of, okay, how I can actually generate some revenue on my portfolio. So some of these things, when you guys first start, like I had a little hard time back, like 10, 12 years back when I started this, like I had like, why is this put? Why do I need really put and call? Can we just have one, right? But once you start understanding, after trying a few things, it actually makes more sense.
I have a basic question. Sometimes, we come across news articles which says that there are some unusual options activity and the stock may be volatile. So I'm just wondering, how does that impact the stock price? And second question to that is, when you look at the stock options, can you forecast whether it is going to go up or go down?
Yeah, so that was kind of the thing that I was referring earlier, unusual options activity. So think about this, right? If somebody is selling a huge chunk of options, and one big chunk of, say, 1,000 options, right? Or somebody is buying 1,000 options at the same time, right? That means somebody is speculating a direction in the stock based on that activity. Sometimes what happens is some big guys are doing it. They know something, or they might have some algorithms and other things that predicting something, right? So you could expect some movement, but does it happen all the time? We don't know. But I would be careful. Like if you do that unusual options activity, usually when you get that alert, they'll also mention whether it's a bearish signal or bullish signal, right? Meaning if somebody bought a big chunk of the 2,000 calls in one block, it could be from a multiple, but its buyer is one. So that means that buyer is bullish, right? They could be paying for some other reasons as well, or buying it for some other reasons, but it's kind of it's a bullish signal, right? When I'm entering into the market around the same time, you might want to just keep an eye for that.
No, but there are no other activities. I mean, there are no other events. There are no other news about that particular stock, but still it becomes very volatile, right?
Yeah, it could when it gets closer to that expiry. For example, if somebody bought like 10,000 options, that means he spent like a few $1 million on it, right, just on the options. If you actually convert that into underlying, right, it could be in $40-50 million worth of stock, right? But sometimes, yeah, you may not see any activity happening around that time. But again, it's something that you have to be cognizant of the fact, okay, somebody is very bullish, right? Is there something I need to be worried about?
Srinivas, I have a quick question, Srinivas. So it is about when while checking the options, right? I see the gamma, theta values. So does it? What does it represent?
I don't even remember now. I don't actually look at it. I'll have to read it up again. It's been a while. So they do represent some of the factors that we were talking about in the pricing aspects. In addition to like we talked about the basics like intrinsic value, time value, right? So unless you're a sophisticated investor, I wouldn't worry about those.
Okay, thank you.
And how good is and one question on the charts, right? Like I know there are many technical charts, many people follow many things, right? But how it really works? Do you think it really works 90%, or what is your experience? Is it really good to learn charts, or it's like 50-50 hit? What is your experience? Just want to understand that, because you want to put the time on the right place.
Right. So I tried to read the charts, but it never worked for me. Maybe I'm not that good. So for me, the way I have done like a lot of strategies, but this the beginner strategies that I have here. Most of the time, those are the ones that I do, right? And occasionally I do the speculative trades, like for example, the game stocks that events happen in the market, which I'm very comfortable to take in the reverse direction. I do those. But few other basic, have few other option strategies I follow, simple ones. But I don't rely on the reading the charts and head shoulder patterns based on and actually writing the options.
Understood. Okay, thanks.
And what is the success ratio in your previous experience? Suppose if you take 10 different options, like how much you see the success ratio?
So it all depends on your strategy as well, right? For example, these beginner options that I'm talking about, so I have been doing this quite a bit on my in my portfolio. I mean, whenever I want to buy or if I already own a stock, I keep on selling the options every month, pretty much, right? So I would say close to 60 to 70% of the time, I get to keep my stock with the covered calls.
Okay.
So that means I'm generating the revenue. I'm still keeping my stock for the upside, right? And for actually buying the stock when I'm trying to buy, as I said, like recently the CPNG, I sold options for 30 and also 28. I'm going to get 30 ones, but I'm not going to get the 28 ones. So those kind of ones, I would say around the same, like maybe 50 to 60% of the time I get assigned. But those stocks I usually, again, at the same, similar, close to the price range, I immediately write a covered call on that, so that I can at least make 15 to 20% on that trade overall, right?
Okay.
Because I know some of these are not like long term, but in some stocks I do play long term. I don't write options, but I would say like 40 to 50% of my portfolio I'm doing these options.
Okay.
Hey, Srinivas,
Hello, Srinivas. Oh.
Yeah, go ahead.
Go ahead. Go ahead.
Okay, thank you. Hi, Srinivas Garu. I have a quick question regarding the taxes. I mean, I'm also a beginner over here. So when you say this covered calls, right? So if it goes in, I mean, if we end up in the money, then we need to sell our stocks, right? So what happens to that gains that we have? Do we need to pay taxes for that? Or?
Yes, yeah, we have to. Yeah, so it's pretty much considered as a realized gain, unless you buy the stock within the 30 days, right? Wash sales. I don't know if you guys are familiar with the wash sale. I'm sure some of you. So if you sell a stock and if you buy the same stock within the 30 days, it's considered a wash sale. So then you don't need to pay, right?
Oh, okay. Yeah, in that particular situation, so I was a little worried.
Yeah, that's the other thing. That's a good question. Like depending on your tax situation, yeah. So even the premium that you collect will be counted towards that. Plus the yeah, if you have any gains in the stock, yeah, so you'll have to pay the taxes.
Thank you.
Srinivas Garu, do you mind like covering the rollover concept of the options? How that works and
I don't do much rollover. The concept wise, pretty much you're keeping on rolling over the options to the next month, following month, or in the future, right? So depending on what's your appetite or how much cost you're willing to put in, so you can actually start rolling to the future months, selling way ahead of the expiry, or so that you're not losing all the premium or basis limits. But I don't do much of the rollovers, so I'm not the right person to answer that.
okay. So I mean, I don't see that option in Robinhood. Do they support this, or do we need to call them? I mean, how that works in Robinhood?
If I have to roll over, I did once or twice, but I did a manual rollover. Rollover is nothing but like closing the position and opening a new position, right? Meaning if you have an option expiring in say September, right? you can close it, and you get that when you close it, you're going to get paid, and use that, and plus any other additional premium that you need to pay to roll it to the next month.
Oh, it's
Like selling and buying the next month. Yeah, I think Interactive Brokers has a rollover functionality where it kind of does that sell and buy in the same transaction.
Oh, okay, got it. Thank you. Yep.
Hello, Srinivas. Could you please walk through your process on how you look for new opportunities? Select the right strike prices, expiration dates, etc. And also, do you use level 2?
Yeah. So selection is again an individual choice based on the risk appetite and all those factors. So I usually, so as far as the picking up the stock symbols, I usually pick the ones that are recommended, or even like in the ThinkSabio, right? We see these recommendations. But on top of whatever the recommendation, I also look for certain market cap. I usually don't pick anything below $1 billion market cap. And I look for how volatile on the volume of that stock. And I try to avoid the ADREs, but again, I ended up owning some of those Chinese ones recently, losing some money, but I just want to disclose that. But I usually try to avoid the Chinese ones. Other than that, it's just the choice. And whenever I'm buying something, based on those two strategies I just mentioned, right? The ones that I'm comfortable with owning, or I'm very comfortable saying that that stock in the long term is going to be bullish. So most of the time, my trades are based on the bullish pattern.
But is there a certain criteria you use, or like indicators like open interest or volume?
Yeah, so I don't look at the open interest from the perspective of should I enter or not, but I look at it from the perspective of, is this a good stock price for me to enter, right? So for example, like Delta recently, I was looking at it because it met my criteria of, okay, it's a decent company, like more than 1 billion, and it has a revenue and all that good factors, and long term, it's a good stock. So trading at 40, I said, okay, I can do the trading at 38. I'm trying to pick the stocks that are kind of range bound right now in the next few weeks. And they're very stable companies. Even if they get assigned, I can hold it, and then maybe down the road I can send a covered call. I know it's a tricky answer, but it will be individual choice, that type of stocks or option that you want to pick.
And finally, about level 2, like, do you utilize that at all to pick how much you want to pay?
No, I don't use any of the level 2 data. I usually just go with my hands. Okay, I just want to get this option for this price, and I just put the limit order.
Okay, yeah, thank you. Hello, Srinivas.
Yeah.
Yeah. First of all, thanks for your time in sharing your experiences and thoughts. So we really appreciate it. So I have a few beginner basic questions. So just as per your strategy, sell out of the money put options. Like you mentioned, the coupon, so the range bound 28 to 30. Assume I want to buy 100 stocks. I'm sure I want to have them for the near future. So does it mean, for example, if you wanted to buy 500 stocks and the premium is right now, like for example, $70, do you need to hold all that 100 stocks of worth of value when you put in the contract, or whenever it gets picked up, I mean, whenever it hits the strike price of 28, like secured put, that's when I need to deposit the money and get my stocks?
Okay, so just to repeat the scenario. So CPNG is trading at $30, close to $29 now, right? And
That's
you're
right.
saying you are willing to buy 500 shares?
Yes, for example, I wanted to buy 500 shares and I've been averaging it. So since you told me the strategy where you get a premium, at the same time, you can average it on the longer run. So assume I want to buy at 25. Actually, I'm comfortable in buying 25 at 100 stocks. That is $2,500.
Yep.
So my question is, do I need to keep the $2,500 on day one? For example, today is Monday, but I don't know when it comes to $25. It might be a week,
Right.
2 weeks, a month, or 3 months. So do I need to put that $2,500 in my account without disturbing it, or I can just buy the contract premium for $100 and then wait for the day when it hits 25 and then you deposit the money and then get the stocks?
Yeah. So in your scenario, just to clarify, so you're going to sell the contract, right?
Yes.
Sell the put contract,
Yes.
say for $1, right? Say 28 is trading at $1, the October one, right? So somebody is going to give you for 100 stocks, somebody is going to give you $100 that gets deposited into your account.
Yes, that's
right?
correct. Yep.
So if the price keeps going down, so you don't need to have 2,800 in your account.
Okay.
Right away. But if the price starts keep going down, so the price of the option is going to go up. Like it might become like it's trading at $1 and now it will become $2. That means you are losing $100 on the option, right?
I see.
You are only
Got you.
expected to have that additional $100 in your account.
Okay, got
So
you.
even if it say falls to $25, right? So option, because of the let's not worry about the time value, just the intrinsic value, based on intrinsic value, it's at $500 option value, right? So now it's you're expected to have at least because you're already 100, like you're expected to have at least $400 in your account.
That's right.
But if you decide to, if you decide not to execute, close the contract as is, you're going to just lose $400. You don't need to actually buy it. But if you chose to buy it, then you need to have the money at that time, or overall, like from the margin account, whatever the money is being drawn, you have to have that capability, right? Meaning that they'll deliver that money either via margin or depositing. If you don't have the margin enabled, then you have to have cash.
Got you. Thanks for the clarification, because I was kind of worried because I'm buying in small chunks by doing the DCA approach, dollar cost averaging, but I was not sure whether I need to have, like, for example, if I need to buy NVIDIA, I have to have like almost $20,000.
Yeah, so that's the advantage with the options, that you don't need to have their money right away, right? Even if you're losing, it's not losing, meaning that you have to only have that the loss on the option in your account to cover.
So if I have a margin account, in that case, will the interest keep on going, or how it is?
No, there is no interest at this point because you're not borrowing any money, right? You're actually
only
got
if you
paid.
borrow. Got it.
Right.
Okay.
Only when you're going long, at that time you're actually borrowing, like you will have interest only at that time, right? Here you still a cash positive, but overall account value should support the negative account. Meaning, if you have other if you still have cash in your account, it's almost think of it as you have negative, meaning you're losing money on an option, right? Just like the stocks when they go down, it will show as a loss.
So Srini, in this case, what you're sharing, this covered call sellout, you need to own the stock, right? At least 100 shares?
Yes, for the covered call scenario, yes.
Okay, thank you.
Hey Srini, one quick question. Did you ever buy historical option data from any source?
No, I did not. I actually worked on this option pricing models back in 2009-10. If you look for QuantLib, JQuantLib, I worked on American option pricing models, but it's so long. Back then, I think one of my other developer, I think he got some data from somewhere. We were running using that data, but I never bought it for my use.
Okay. Well, there are a few sources, but I don't know. I want to know which one is the cheapest and a good one.
Okay. Yeah, I have no experience in that, so. Yeah.
Okay. Thanks.
Hello, Srinivas. I have another question on basic options. So, for example, any day I see this is just by observation. So whenever you open the market at 9:30, your option prices contracts are really high. And on the same given day, if you like based on even there is only 2% or 3% move, by the time around lunchtime or 1 o'clock, the contract value, for example, it was at 9:30 $100, and at 1 p.m. it becomes $70. So how do you judge what is the fair price for your contract? Because if you do 1 week, it's different. If you do 2 weeks, different. As I was going through your session, I was just checking random prices within week time, 2 weeks time, month time, like what you shown in Yahoo. So what would be the ideal strategy or basic beginner strategy so that he or she is buying at the right level? I mean, instead of paying $300 for an option contract, actual reality is $150, but I'm overpaying because I'm in fear of missing out. Something is going to happen.
Yeah, so a couple of things, right? So so option pricing is mostly dependent on 3 factors, right? So one is the intrinsic value, right? So which we talked about in the money. The second is time value, right? So farther away from the expiry, the more expensive, and the volatility, right? And also, of course, so underlying market conditions. If there is some fear going, it's volatility, pretty much. So I'm not sure if the underlying cost, underlying market price remains the same for the whole day, and other condition remains. Usually, the option price, I don't see much movement. I'm not sure how to address that. Other thing is right now it's out. So other thing I would suggest is if the volume of that underlying stock is low, usually option price will have too much bid and ask spread, right?
Got you. Yes, I've seen that. Like sometimes it's like $50, sometimes it's $10. So I was just trying to make sure I try to buy consistently.
After hours, if you see any data bid ask, that's completely out of whack, right? So I would never even consider that as a good data point. So usually once the market opens, that's when the actual the option, the bid ask ones start reflecting in the actual ones that the people are actually willing to sell or pay for. That too, I would recommend picking up the ones that trade most, like indexes, even like Apple, like big things like we are starting with. So that way, if you have fear of losing money between the bid and spread or any other conditions, they have, since they've given the volume and other availability, those are better. Like if you're worried about those kind of things.
Got you. The reason for asking is because sometimes I was in a dilemma to do averaging or not, because if you Google this averaging for options, there are multiple subjective answers. So it depends on specific case scenario. No one can just point out directly, hey, just go ahead and average because it's bullish. Go ahead and average because it's bearish. Because when it moves sideways, your value is also changing very rapidly. Even like Apple, like the other day, I tried to do one basic option because there was an iPhone sales event, but the lawsuit popped up just before 3 days. And then I couldn't, I averaged it, but still I got into more losses, assuming that I can get out with less risk. But my risk management overturned on me, and then I'm in a range of, instead of losing 30%, I'm losing 60%. But I know the options are risky, but I'm just trying to explore and learn. Yep. So that's the reason I was asking the question, because averaging is recommended or not. Yeah.
Yes, Srinivas, question. So do you, I mean, when you choose an option, right? So do you look at like any chart like RSI or like, I mean, MACD and anything? So, I mean, I know like, I mean, if the topics, if everybody has like, I mean, these kind of questions, is it okay to cover that? I mean, you don't need to explain like RSI and MACD if some people know it. And the way like, hey, I mean, I look at this 3 months or 1 month. I mean, so, I mean, is there any, what do you follow? I just wanted to know if you ever follow a chart.
Yeah, I don't actually look at that.
Okay.
So I do look at some indicators on like Yahoo, for the finance.yahoo.com, right? So they have some indicators like basic indicators. What is the fair value? I think they kind of take into RSI, all those indicators, they come up with this, and there is signals here, right? So I kind of look at these signals here.
Okay, I do.
And then, as I said, like I'm mostly looking at, okay, what is the performance of the last year, and what are the, or what should my entry point should be, and those kind of things are more based on my the strategy that I'm going to execute on that stock.
Thank you.
Hi, Srinivas. This is Harish. I have a question. I'm a beginner in options. As you earlier you mentioned that we have like a weekly and monthly options, right? In that case, I want to start with, like you mentioned, start with indices like a SPY, these ones. So what would be the ideal one? Should I try the weekly ones, or what do you suggest? Should we go with weekly or monthly?
Yeah, so
for the
if you're doing
beginners?
the indexes, I would suggest weeklies because even the volume for weeklies is very high. Like if you go with SPY or IWM, some of those.
Okay,
yeah,
thank
my
you.
suggestion would be weeklies. Yeah.
Thanks.
Hi, Srinivas Garu.
Yeah.
Do you use any tools or something like to check the flow, or like how you decide like which one to get into, play the options?
So I do use, I don't know if I want to call it like few things. I do look at our ThinkSabio sometimes. I look at all the top holdings and I kind of look at what their current market price, because most of the time when I'm writing the options, I'm also looking at the underlying stock price. So at least for me, the sweet spot is I'm trying to enter between 10 and 60, meaning under the current market price of the stock is, right? Occasionally I do enter up to $200, but I try to avoid more than that, because just in case if I had to buy the asset, so I'll have to have a lot more cash in there, right? So I do look at, okay, here are all the things and I kind of pick and choose, and then I go to do my research on, okay, what their market cap is, and then what are the trends for that stock. Just look at some of the signals, the bullish, the trends on this Yahoo. So other than that, I don't actually use much other data, but I'm just looking for good companies to trade options on.
Got it. Thank you.
Yeah, so with these options, it's all individual choice. Things that work for you, that's the thing I would recommend. And just stick with that pattern, right? Of course, you always want to explore a few other patterns if they work, and then you kind of add that to your tool set. Okay. So I want to just, I don't know, and it's already 2 hours, 20 minutes. I just want to cover one scenario.
Srinivas,
Go ahead.
if you don't mind, I have one question. I'm actually looking at Robinhood, and if you can switch to Robinhood, I have one question. I'm looking at this CPNG, and I'm looking at sell put, whatever you just covered. I mean, I never did any option trading till now. I'm just like, I'm listening and trying to look at it. I'm looking at like, sell put. And yeah, can you scroll down to the bottom?
Yeah, so one thing is this right now it's defaulting to September 7th is tomorrow. So it's there is no time left, and no this one day.
Right? Look at December 17th. Look at December 17th.
Okay.
17th. If you scroll down, yeah, it says like $15 is a strike price, and the break even is 14.92, and it's the price is like 8 cents. What actually it means?
So if you look at these columns here, right, they're saying a break even point. Meaning if you buy, in this case, so if you're selling it for 8 cents, right? As long as like break even point in the sense like there is a zero gain, zero loss, as long as stock is at 14.92, right? So that's what its break even point is, because Think of it just $15 minus 8 cents, right? That's a simple calculation, right?
Yeah, that's fine. But now let's say on December 17th, if the share price is still at, let's say, $30 or $30 issue, what happens?
You get to keep this 8 cents because when you sold this contract, $15, so other side is going to give you $8, right? Because you're going to only make $8 because your option is always a contract is for 100 shares. That you're saying by selling this, you're saying that I am going to sell this stock to you, to the buyer, for $15, independent of stock price. I mean, if it is above $15 anyway, other party is not going to exercise it, right? Because it's more like other guys bought it as a protection, meaning if it goes below 15, so that it's like they're buying insurance for $15, right? If it is above 15, they're not going to exercise. So if it is stays above $15, you get to keep that 8 cents. Okay, so then, the price is very, like you say, 8 cents because they're not expecting it to go down to $15, right? That's why the price is so low.
Okay, and if it stays above 15, we get to keep that 8 cents. Sorry,
$8. Yes, yeah, $8 after $8 after the commission. So usually around 65 cents. When the price is low, you also need to take into account the commission as well. At 65 cents, I don't know if that Robinhood is still charging commissions for the options or they're not. But if they are, just take into that. So at least the average rate they charge the 65 cents.
Okay, and when when you incur loss in this trade, and when you incur profit in this trade?
Yeah, so you incur profit of $8 as long as stock is above $15, right? Say the stock fell to $10 by December, okay?
Okay.
So that means the difference is $5 because you still need to buy the stock for $15 from that guy, right? But the market price is $10, so you're losing actually $5. So you're incurring $500 loss on the 100 quantity. So if it goes below, that's what the break-even price is, like including the premium. If it is below 1492, right? Any price below 1492, you're starting to lose. Okay. Your maximum loss is $15 if the CPNG becomes bigger, right? Which won't happen, but the worst case, if for any reason it goes bankrupt by that time, the maximum loss you incur is 1492.
Okay, and since I am buying irrespective of whatever the price on that day, I have to buy from that guy for $15.
That's right, right. Because he's not going to sell you for $15 if the price of that stock is above $15, right? So that's why if it's anything at or below, our option will get exercised. It will get assigned automatically, actually, or it will automatically close, and if you don't have funds, it will automatically close, and you will see that loss.
Okay. Yeah, understood, Srinivas. Thank you.
So I just want to cover one more. Hopefully, it's not too late for everyone. Thought I had this one chart to. Okay, I don't have it. Oh yeah, here. Okay. So all the ways you can make money in the bull market, right? So everybody knows buying a stock, meaning if you go long, you are making your money, right? If you buy a call option, you get the right to buy the price, and if the stock price goes up, you're making money, right? And selling a put option out of money, if the stock price goes up, you get to keep that premium, so you're making the money, right? So I want you guys just think about this deep in the money option. If you, I don't know if maybe not all of you heard about this Buffett options. It kind of triggered a lot of discussion back in time. Even now, you must have seen a recent news in CNBC somewhere that somebody actually did something like thing, and they are betting for $195 million, right? So any hedge fund, any of these investors, they are always doing options trading. Some of those options, they don't need to report if it's a short options. So you may not see that in some of the SEC filings, right? But in this case, Buffett actually reported this. So what Buffett did was, back in 2004 and 2008, they sold calls on indexes. Indexes are another SPY index, right? So simple use case would be they sold 2,500 options or two, like SPY. If you take, let's do the relative thing. Back in 2008, the index price was at 800 or 900. It was going down, right? And the Buffett, they started selling the put options for the 2001, and they collected $1,100 premiums, right? So they kind of sold various prices. Let's take the case where they sold at $2,000 indexes. So they made on each contract, each stock, I would say, at each index stock, they made close to 1,000 or 1,100. So they actually sold so many options. They made like $5 billion. But they betted that market is going to go up and above 2,500 S&P index. And it's going to stay there till 2026, right? So he made $4 million in the options premium. And of course, he's just using that to do other tradings as well. So that's the other strategy. If you guys are very confident that, for example, CPNG is going to be at $60, and this one, let's, for example, let's go to Jan 2024, right? So if you are confident that it's going to be about $45 by Jan 2024, so you can actually sell the options right now for $19.20. You can make $20 right now. And as long as the stock is above 45 in 2 years, you get to keep that premium. And I know this is a little bit advanced, the guys who are already doing the options trading. So something to just think about. Good use cases would be when the market is crashing, like the one that did last year. It's a good thing. You can actually look into writing the selling the puts on the index itself, assuming that eventually the market is going to recover. So you can pretty much sell the leap option so that it's down the road. And we know that eventually the markets will recover. And at any given point, of course, the market actually shoots above that level. You can just close it and keep the profit.
So in put cells, like your max profit is always the premium that you collected. That's it. That's
correct, right? So in this case, my maximum loss is going to be $45, right?
Mm-hmm.
And yeah, my maximum profit is $19.
Okay.
But in this scenario, I think I need to have $4,500 blocked in my account, right? For that whole period?
No, you need to have the amount reflecting here, right? As you start losing the money.
No, I think that's the money I'm getting, and the strike price is $45.
Yeah. So yeah, there's a couple of factors depending on the stock. Some of this CPNG might be a bad stock because the margin requirements might be high for a CPNG, right? So they also use the margin requirement to calculate how much cash you should have.
Okay. So if I buy the Microsoft or something like that, then I may not need like a whole price, like strike price is $100. Then I don't need like 100 into 100.
Yeah. So if you are using a TD Ameritrade, like they actually show you for each individual stock what's the margin requirements. So you can actually calculate based on that. Of course, that keeps changing based on the market condition, but at least you'll have a good idea of how much cushion you need to have in your account value.
Okay, put buy is nothing but like I'm predicting that stock will go down, and there actually the profit can be unlimited, but loss will be limited.
Yeah, so here I'm selling the put, right? As a seller, as a buyer of the put, I am.
Can you go? No, sorry, Srinivas. Like, can you switch to buy? Put buy.
Yeah.
Yeah. So, yeah, here, what this means?
So buying a put means, so for example, this is a buying put for 2024, right? If I'm buying a put for $19, meaning I'm buying a protection for my stock that I already own, and I'm spending $19 as a premium. Or that's one scenario, or other scenario, if I don't own the stock, but I'm just buying a put and I'm expecting it to fall below 49 minus 20 is almost 20, right? So below $25 to make any profit if you are a buyer of the put.
Okay.
If I'm a seller of the put, then I'm expecting the stock price to stay above 45 so that I can get to keep the premium by this date. So this kind of long-term leap funds, my recommendation would be to, yes, some of these stocks, if you're very confident you can do, but look for opportunities in the India indexes and the ETFs. When there is a big correction in the market, we know that it will eventually recover, right? That you can actually write like 4 or 5 months or even 6 months away, which we know the market will eventually recover. So at that point, you can actually even close it or let it expire. Even if it's assigned to you, then you're just holding the index. Hopefully, it will go up eventually. So.
Hey, Srinivas, do you have any, I know, like any channel or like, anywhere, like, you can post in ThinkSabio also, right? When you buy and sell, what are the options when you're buying?
Yeah. Good question. Yeah, so I was just talking to Sai and Danu earlier. Yeah, I'll maybe going forward when I'm doing some trades, I'll just post my trades, so what options I'm buying, selling. I'll just give the reason so that at least others can see what I'm doing.
Yeah, at least you can say like expiry and then what is the call you bought it and what is the price, just like in one line, right? So it's up to the folks, like, right? Like today, if Sairam always like say post, right, his trades, like, but it's up to the folks whether to buy it or not, right?
Yeah. It's up to the individual.
Yes, thank you. That would be really helpful for us.
As if I may suggest, if it's possible, I know you covered most of the basics today, but if there are people who have some basic knowledge, right, who would like to enhance our knowledge. So if you can focus a little bit on the advanced strategies as well, like and adjustments in some other time, that will be very helpful.
Yeah, definitely. Yeah.
Thank you so much.
Thank you, Srinivas, for agreeing to post some of your trades. So it will be easy for us, like learners, right, to start with small. Thank you so much.
Yeah. So I would definitely recommend just start small. Pick the ones that that you're more comfortable with.
Hello, Srinivas.
Yep.
జస్ట్ ఇక్కడ మీరు పుట్ తీసుకున్నారు కదా, కాల్ తీసుకొని చెప్పారా, కాల్ బై అండ్ సెల్.
ఓకే.
So in this case ఏమైతుంది, sorry, what will be happen?
Okay. So let's take a different date here. Yeah. Okay. So current market price is at $30. So I'll stick with maybe $40. Maybe. Okay, so 29, current market price is $29.40, right?
Yes.
So I want to buy a put, $30 put, right? $30 strike price put. So here, if I want to buy a put, I'm spending $1.33 for each stock, right? That means I'm paying.
It's a call, not a put.
Sorry. Yes, I'm buying a put. So I'm buying a call. So I'm paying $1.33. That means I'm paying for 100 stock. I'm paying $1.33 to the seller of this call. And my speculation is it's going to be by October 15th, the stock price is going to be above this price, this break-even price. So break-even because I'm writing the contract on the strike price of 30, and I'm paying $1.33 for this call, right? So that means as long as the price is above $31.33, the market price of that underlying the stock, I'll make money. If it is below that, I'm not making money.
So you do so $1.33.
So there are various scenarios again, like if it is between $30 and $31.33, right? It's still in the money, but I'm losing that difference. If it is if it goes to $31, I can still buy it at $30, which is a good thing. But my overall, I paid a premium of $1.33, so I'm losing 33 cents. So if it stays in between, if the market price stays in between these two, then I'm losing whatever is the difference from here to here.
Okay. Then
And if it is below $30, then I'm pretty much losing all my $1.33.
Okay.
And if it is above $1.33, right, $31.33, then I'm making money.
Okay. So if it goes about $31.33, if I don't buy it, I can still collect the premium, right? I mean.
Yeah, so there are two scenarios. If it is above $31.33, you can say, I want to go ahead and buy it for 30 because the other guy is going to give the stock for 30, right? So you have unrealized gain of whatever is the current market price. Or, I don't have $3,000 in my account. I'm going to just close the contract, and I'll just say if it went to $32, right? So I'm going to get that remaining 32 means $200 from the.
Okay. So you don't have to buy the actual underlying stock then.
That's correct. Right? On the last day, you can see that if it is close to this, it will be pretty much a difference between the strike price and the market price. You can actually close it with that difference. So if it is at 32, you'll see that option is actually trading at $2. You'll be able to close it. But if you don't close it, if it's in the money, I never had this situation. I always got assigned, but I don't know if you don't have money to cover that, maybe they'll automatically sell it. I haven't into that, but in that case, I would just close it and take the $2.
Thank you.
In this case, sell, how does it work?
Yeah, so if I am a seller, right? As a seller, I'm selling it for $30 of this call, and buyer is paying me. I'm the receiver of $133, right?
Okay.
I make money as long as stock price is less than $31.33.
Okay.
Meaning if it is below $30, I get to keep all of it, $133, right? If it is between 30 and $31.33, whatever is the difference is, I get to keep. Like if it is maybe on the last day, if it's trading at $31, then I'll make $33.
In this case, do you need to own the stock because you're selling, or?
No, you don't need to own the stock. Okay. Because you are promising that you're going to buy, right? As a seller of the call.
Okay.
You are promising to buy at 30, but you have unlimited risk, right? If suddenly the $30 stock goes up to $1,000, right? then, sorry, other way around. So you have, I lost my thought there. So
if the price goes above 30, right?
Yeah, so if the price goes above
31.33,
so you are still expected to buy the stock for or sell the stock for 30. Yeah, as a seller, you need sorry on the sellers right now. So as a seller, you're promising that you are going to sell the stock for $30. So even if the price goes to like $1,000, you have to sell the stock to the other guy for $30.
It goes down.
If it goes down, anyway, the buyer is not going to buy for $30, I do think, because he can directly go to the market and buy it for say $29. Right?
We'll just collect the premium.
Yeah, you can just keep the seller would simply keep the premium. So in this case, as a seller, maximum advantage you have is 133. You get to keep the premium. Yeah, so selling a call is nothing but you're shorting in a way that you make 133, but your downside risk is unlimited.
Srinivas, in the same example, buy, call, can you explain the difference between buying a $30 call versus $25 call?
Yeah, sure. So if you're buying a $25 call, so that means somebody is willing to sell you the stock for $25, right? Independent of the market price, right?
Mm-hmm.
So if the current price is $30, somebody is saying that, oh, I can sell you for that $25, meaning there is a difference of almost $440, right? So that's why the premium is more. So usually when you add up, when the, this is called in the money, meaning you're trying to buy a put, so buy a call, which is less than the current market price. So your strike price is less than the market price. Mm-hmm. So which means it's already in the money, meaning if I buy it and sell it today, I'm making 470, right? Meaning it's like neutral, but if somebody buys it for $25, $30 one, you have a table profit of 440 in this case. So when somebody is selling it, they're going to include the difference in the price. That's why you see that it's 470, meaning, so if you add this 470, there is a 30% premium in there, right?
Mm-hmm.
So yeah, you are buying for 470 as long as
a buyer, which one is best in these two examples, 25 call or 30 call?
Okay, so it depends. Here you are spending $4. If you are bullish, right?
Right.
You are spending $4.70 for being a bullish, right? I can even buy $15, but I'm spending more, right?
Mm-hmm.
Usually what happens is at the money calls or out of money calls, the premium outside of that intrinsic value will be less. So for the at the money ones, it will be high. For deep in the money, it will be low. Meaning if I buy 21, you can see that there is only 5 cents gap, right, to the current market.
Mm-hmm.
Right? As you start going up and up, there is 10 cents here, right? Because 22.5, right?
Right.
So it kind of starts reversing a little bit on the other side. So that additional premium that you are paying goes down, but you're paying up more upfront, right? So I would try to pick something close to at the money so that I'm not spending too much, right?
Okay.
So at the same time, I'm not paying too much premium. So if you look at like some of the highly volatile ones, you pay a lot more additional premium for the ones that are closer to the money. But if you move further away, it's almost like going long. Like if you add up the strike price plus what you're paying, you'll be paying maybe 10 cents or 10 cents, 15 cents. But the at the money ones, you'll be paying like 40-50 cents.
Okay.
So if you want to play with that's what you should be looking at, right?
Yeah, sure.
I think yeah, we're close to your mark. Thanks, guys, for taking time. This was my first one and doing on this topic. So, and I jumped kind of all over the place. Hopefully, some of you have some useful information. Maybe we'll plan to do more. Maybe we'll start getting the content based on the type of audience as well. And also we'll keep it open discussion so that we can learn from each other.
Yeah. Thank you so much for wonderful sessions, Srinivas. I'm looking forward for those trades in the channel. Okay.
Yeah.
Thank you. Bye.
Yeah, I'll definitely post again. It's again, you guys have to make your individual decisions.
Of course, same, right? Yeah, the risk is always there, right? Even if you purchase a stock, also, it is the same risk, right?
Yeah.
Okay. Thank you.
Alrighty, guys. Thank you all. Good night. I'll talk to you guys later.
Thank you, ST. Yeah, we'll catch up.
Thank you, ThinkSabio.
Thank you, buddy.